If customers go in somewhere, it doesn't matter how great your brand is. It doesn't matter if you have golden arches. People will go to a different business.
Yeah.
And so that all comes down to culture, and who you hire. At a store level, it starts with who is the store leader. And in my business, we sell a lot of strawberries. So I love to use the moldy strawberry analogy. But if you ever get a tub of strawberries and you put them in your refrigerator and you open up and there's one of them that's moldy, if you pluck that moldy strawberry, every other strawberry stays bright and beautiful and juicy and ready to eat.
Yep.
If you leave that moldy strawberry in there, it's game over. The next time you open up that, 2 or 3 are going to have mold. The next time you open up, 5 or 6. And that is really the game of retail and restaurants and everything.
You're listening to the Accredited Investors Only podcast presented by Accredited Life.
All right, Justin, welcome to the show. How you feeling tonight?
Hey, Peter, good to see you again.
Yes. So I always like to start with the guests introducing themselves. So, Justin, who are you? What are you doing? Why are you here?
Yeah, hello. My name is Justin Sloan. I'm the CEO of Sloan Capital. We are a restaurant and real estate syndicate that kind of over the course of the last 10, 12 years have just kind of slowly been buying and building things with a group of people. I hate the term, serial entrepreneur, but, right out of high school, flipping different things that I could, and then going to the mall and hustling cell phones, eventually building my own business, to buying buildings that I was located in, to now, running a syndicate. So it's been a fun game, and look forward to talking to you about it.
Wow, awesome. Was that just kind of something that came to you naturally, or did you have somebody that you looked at that was doing that, or how did was the entrepreneurial bug just something that you fell into, or what's that look like?
Yeah, so I was raised by a single mom, 3 boys. So naturally, my mom was just a hustler. At all times, had kind of 6 or 7 different gigs, from delivering newspapers to waitressing to this to that, to anything to, make a quick dollar, because you had 3 boys you had to feed, right? And then as I got older, I kind of realized, hey, my mom works really hard, but she doesn't really work all that smart, And so when I learned how to kind of arbitrage things and grow and build a business, I kind of chose to do it, rather than hustle just to go pay for things one time. What if you could hustle and build something that continues to pay for it multiple times?
Yeah, that's awesome. I talk about like a mindset shift that I'm sure was life-changing in a lot of ways. So let's talk about the restaurant business. What brought you into that world?
Yeah, so right out of high school, I built a chain of cell phone stores. So I kind of got into the world of repeatable businesses. As I was saying, when I was a senior in high school, every day at noon, I'd leave my classes and I'd go to the local mall and I'd sling cell phones from 1 p.m. until 9 p.m. Made commission, and the more phones I could sell, the better. And man, did I sell a lot of phones.
Wow.
Ended up going to college a little bit and dropping out, and then ended up starting my own cell phone store. I was the only employee, worked open to close 7 days a week until I could hire someone, and then open another store and another store. And then I got into real estate. But where I found restaurants is actually in the middle of COVID, when every restaurant was shutting down and, not allowed to serve food and all this kind of stuff. I actually came across a company called Everbowl, which is bowls of things that have been around forever, kind of a Chipotle of fruit. And I'm born in Iowa, meat and potatoes. This is not the kind of food I ever thought I'd be getting involved in. But when I tried the food, I literally just kind of had this light bulb moment. Because if you can get me to eat ingredients that I can barely pronounce, that I know are good for me and taste good, well, the world needs that as well. And then Drew Brees was coming into the company and helping become a big part of it, and a number of other things. So I kind of took my knowledge of repeatable businesses mixed with my knowledge of real estate and said, well, if I can pair these things together, we can create a lot of jobs. We can make money for our investors. We can grow a brand that, delivers healthy meals all over the country. And the stars, like I said, kind of aligned for that one. Let's go make a big swing at it.
Gotcha. So what does it look like? It sounds like it's a franchising model, or so talk to me about the details and that, and kind of the structure, how the model, how it all works.
Yeah, so Everbowl is a franchise. They were started out in San Diego, and I found them when they had about 26, 27 locations, and they were just getting ready to franchise. So I ended up actually buying the rights to the entire state of Texas for the company,
Wow.
and then started my syndicate opening restaurants. Then we also franchise, so we sell off territories to other owners. Obviously, I can't own every store in Texas myself, nor do I want to. But what's really cool is I've got my syndicate that's opening locations, and then we've got franchisees and all across the country. There's a store opening every 5 or 6 days right now. And so, we're all kind of rowing the boat in the same direction. But with my syndicate, we created a way to fund these restaurants. We do them in batches so that you get some diversification across different, cities, different areas, all that kind of stuff. And then they're debt free. So, one of the hardest things with restaurants is, debt or low margins or whatever. And so because we have a repeatable model and we're funded with no debt, it's a little bit of a cheat code.
Well,
We're going in and we don't have to worry about what our food costs are, what our menu looks like, or how we market. It's just how many times can we do this over and over and over again? And with that, the restaurants become profitable a lot faster. They pay out to investors a lot faster. And I'm just trying to I really believe that, where the puck is going, as Wayne Gretzky says, right, is that real estate owners are wanting to now own the businesses inside of real estate. So Blackstone recently bought both Tropical Smoothie and Jersey Mike's. Why are they doing this? Well, when you know that X amount of people go get their sandwiches or go get their smoothies over and over and over again, why would you just want that piece of rent when you can have a piece of the food and the this and the operations? And, that's what our syndicate is doing.
Gotcha. Interesting. So you guys, you own the real estate, correct?
No. So
Okay. So you,
in the restaurant concept, no, we do not as of right now. I think at some point you'll see us pair it all together.
okay.
But we started actually buying real estate, specifically commercial, absolute triple net, strip malls. So I know that world like the back of my hand. And then with the Everbowls, we lease small
Okay.
pieces of real estate, 1,000 square feet here or there, and then have no debt on them.
Gotcha. Okay. And how does it have no debt? You're able to raise enough capital that you don't need debt. And what is it? What's the typical cost look like to start a store? And what do you need money for? Like what does that all look like?
Yeah, so we raise at a $400,000 per location valuation. We only raise part of the capital, and then Sloan Capital actually puts money in right alongside of our investors, and that's how we do it debt free. So again, it's not something where we're using leverage or waterfall structures or anything along the lines of that. Because we have such a repeatable model, we know before we even sign the lease what the construction costs will be, what it will cost to open, what our runway. We've just done this so many times that then we build a model that says, hey, we're going to put 6 restaurants or 12 restaurants into that batch. Our investors fund them. We go execute the model and open them. And then as the restaurants become profitable, the investors begin to get paid out. It's a true equity deal. So we don't have, like I said, there's no pref splits, there's no waterfalls. It's just our investors truly helping us create jobs, serve healthy meals, and be part of an incredible brand.
Gotcha. Awesome. So what does it look like yeah, from a finding locations? I mean, where do you want to be? You kind of mentioned it a little bit, but just to bring some more focus to it, you paint the picture there. And then my follow-up question is going to be, just so when you find a location that you like, where does it go from there and on?
Yeah, so we start, at a really high level, 30,000 feet plus, looking down, looking at which cities. And we hire companies that do this professionally. So you can find a company that can take your average location, look at the traffic counts, look at the demographics, look at the population. And then what they can do is they can extrapolate, over the course of the entire United States. Or as I'm getting ready to go to Houston, we can map the market of Houston and it tells us which cities we should go after down to the square mile of where our best quality most customers are at. So then we know where to.
Okay.
From there, we then hire local real estate experts to help us. There's nobody better than the people that live in the actual markets. They know the landlords, they know the intersections, they know when someone's getting ready to go out of business or behind on rent. And so they help us find those right spots. Fortunately, with Everbowl, landlords love us. We are a simple, clean concept. We're closed, by 8 or 9 p.m. every night. We have little trash. They're so tired of vape stores and more So when you can bring them a proven model, easy build out, all that kind of stuff, and then, we get to work. We sign the lease, we're locking ourselves in for at least 10 years, if not having more options above that, which is great for our investors because if every year our rent only goes up 2%, but we grow sales 7, 8, 10%, well, over time, your margins just keep getting better and better, and your growth, just keeps on widening. So that's all there is to it. We have construction teams in all these cities, architects standing by, ready, and it's just rinse and repeat, do it again, do it again. Once it's built out, we turn it over to our operations team. They have an entire playbook that they do from, before we even open to, seeding the market, getting this, creating friends, having a monster grand opening, retargeting, all that kind of stuff. And it's just a system over and over. It's no different than when I used to buy and flip houses, and how would I buy it? I'd do the same cabinets, the same flooring, the same paint colors, all that kind of stuff. And we're doing the exact same thing just with restaurants.
Gotcha. Wow, I have so many questions right from there. And what's the relationship look like to the overall? What's the name again? Is it Everbowls or?
Yep, Everbowl. Yep.
Everbowl. Okay. So, and what's the relationship look like with corporate then? Once you purchase the rights for all of Texas, was that where the relationship kind of ended, or I'm assuming they continue to get some kind of a royalty or something like that?
Yeah. So I mean, we are basically a franchise of Everbowl. So literally from the point where if anyone in Texas applies to be a franchisee, it actually comes to Sloan Capital.
Okay.
So Drew Brees actually owns the rights to 13 states, and he has a team that's helping execute this. And so basically what it does is instead of having a bottleneck of everyone having to fly to San Diego, do their training and find their real estate and all that kind of stuff, instead in Dallas, we created a training center and we have an area where people can go and go through the process and and then if you've got supply chain, guess what? Issues or whatever, you can talk right to my team. We help you figure it out. And so you're getting much more of a local support. Then Everbowl helps give us the tools to help be successful, right? How do we go and, walk through of all of our locations and judge our locations and properly roll out, new limited time offers and new product lines. So they're helping kind of guide the ship, and then we're executing it at the state level. And there's a lot of brands that do that. And it's just, especially if you're a hyper growth, with Everbowl opening, 40, 50 locations a year, it's really nice to have kind of Breeze's team have their spot in Indiana. I've got my spot in Dallas. Everbowl has theirs in San Diego, and we're all just doing our thing. And, you wake up one week and there's another couple stores, another couple stores. We just keep on expanding around the country.
Gotcha. Now, are these usually in line, like in a strip center or something like that, or do you do any standalone stores? And is the concept different if so, or?
Yeah, we don't do any standalone yet, just because obviously the real estate costs with that, the build out, the overhead, the everything. So what I love is, strip mall type of locations or something with a great anchor. So a great grocery store, a great gym, active areas where there's people already. We want people to trip over us. And so as you're going into Target, we want to be right next door so you can grab a smoothie and go wander through Target instead of grabbing your Starbucks, right? And so when we're near those daily needs type of places, workout places, shopping, active type of areas, we do really, really well.
Gotcha. Interesting. So, what's the relationship look like with you and the franchisees that you work with? Because it sounds like there's stores that you operate yourself, and then there's other stores where you work with the franchisee as well. So, what does that relationship look like?
I call it my little army of Everbowl owners, because we're all doing the same thing. We're just doing it in different markets. So what we do is we sell off the territory, and then honestly, we leave the franchisee alone. And that's what they want. They're buying a business model, And I don't believe in the subway type of model with one on every corner. So we sell the territory, we give them protection around that territory, and then we support the hell out of them to help them win as much as possible. You know, I mean, Texas, if Texas was its own country, it would be like the ninth largest in the entire world. So, you know, there's no need for us to compete against each other. Instead, our franchisees know each other, they communicate together, they share best practices together. And then also, I'm doing the same thing. So I own stores, I have the same challenges, you know, we're growing, all that kind of stuff. So it becomes this amazing relationship where it's like, how do we go do those things together? You know, in Dallas this weekend, one of our franchisees and us partnered up to do a catering at a large pickleball, nationally televised pickleball tournament. You know, they kind of got the lead. They were a little worried that it's a really big event and can they deliver? Hey, no problem. We'll step up. We'll help you with this. And it becomes great for the, you know, market of Dallas and, you know, and us making sure that we deliver for that customer.
Mm-hmm. Interesting. So, how does the relationship look like? Is it a royalty? Is there does there any money go towards marketing and things like that? Or I mean, what is that kind of, you know, what are you getting from I'm assuming there's franchise fees and then profit split and all that kind of stuff.
But every AR deal is a little different, but it's, you know, assuming that, you know, once the franchisee gets open, then there's a royalty split of some way, shape, or form, depending on the services that you help provide. You know,
Okay.
so,
Okay.
you know, we help everything, you know, we are a turnkey. So everything from onboarding to finding real estate to training to we are literally there at their grand opening the doors with them, training their team that week, you know,
Wow.
all that kind of stuff. So, you know, different brands do it different ways. And
Yeah, that's what's curious.
but yeah, I mean, the way that, you know, ours works is we are the full franchisor of Texas. And so we are helping everybody from start to finish. And with that are compensated along the way to help with Everbowl's overall goals. And honestly, it makes them not have to focus on Texas. They go focus on their states and Breeze focuses on his states. And we, like I said, we wake up and just keep on growing this brand at record speed.
Yeah. So, do they need to order from certain suppliers and things like that from a consistency perspective, or what does that look like?
Yeah, so I mean, part of buying into a franchise system is you are buying a repeatable concept. So from your point of sale, do you have the same point of sale that gives you access to an app and a website and online ordering and DoorDash and third, you know, all that stuff. But then also down to your food suppliers. You know, we have already negotiated national pricing, so you don't have to worry about going and fighting for your certain things. We have a lot of proprietary products in our stores, which is great and allows it so you can't get things anywhere except for Everbowl, and we make all those introductions. So it is, you know, you know, it's a big piece of what you're buying into with a franchise system is buying into a system. And you don't have to go figure out all these things. Instead, you just focus on sharing it with your community and going and getting customers and making sure those customers leave with a smile on their face. You know,
Yeah.
you shouldn't be worried about what's the recipe or how do I do, you know, all that kind of stuff should just be rinse and repeat.
Yeah. So, we talked about it a little bit in the beginning, but I'd like to take a little deeper dive and get a better understanding on what the relationship looks like with investors. You know what I mean? So, somebody was interested in participating in this. I mean, how do they get involved? What is it? What does an offering look like? You talked about, you know, the fact that these are funded fully through equity. There's no debt, all that kind of stuff. Yeah. Is it? What was the hold period look like? You know, well, just kind of break down what a sample kind of investment would look like in the business.
Yeah, so I'll talk about actually, I'm not sure if you've heard of FranShares. FranShares is a fractional franchise investing platform.
Cool.
So it's similar to crowdfunding of real estate. They do crowdfunding of repeatable businesses. So I actually was just chosen as their new opportunity, and this is the last fund that we'll be doing. So I'm just going to tell you how I structure that one. By the time this podcast comes, I don't even know if it'll be full or not, you know, but again, this is kind of just the way that we structured it and kind of can introduce people to this world. But
Okay.
you know, originally what we did was we did 3 to 6 store batches of restaurants. These were specifically in one city, so you could own, you know, part of 3 Everbowls in Dallas. I said we raised at a $400,000 per location valuation. So, you know, a total batch would have been 3 stores. but now we're doing one large final batch. Again, we already have 10 locations open. We have another couple that are already funded and are being opened right now, but we're raising for our final batch of these, which is actually 24 Everbowls all across the state of Texas. These will be opened over the course of about 2 years, 2.5 years, a total hold period of about 5 to 6 years. So the total fund, if you think about it, 24 stores times 400,000 valuation is about a $10 million fund. We are raising $4 million of that 10 million for 40% equity. And again, equity. So if somebody puts in $100,000, they own 1% of 24 restaurants. And that is, like I said, there's no debt on them. So as each restaurant becomes profitable, whatever that profit line is, they receive 1% of it. No pref splits, no waterfalls, no worry of debt or reconciling whatever. It is strictly an equity-based play. And what I found is that's exactly, I'm an investor in a number of different companies. And as I talk to different investors, I wanted to make it juicy for them. I want to make our investors, I'm still really young. I'm going to do this for another 20 or 30 years. And I want to make sure our investors win and they win big. So I just went pure equity, no splits. We win when they win. We're putting our money right alongside of theirs. And let's build this freaking brand all over Texas and the nation and eventually sell it off. That's obviously the goal.
Gotcha. I was going to ask you. So the goal is to sell that to private equity, I'm assuming, at some point.
Yeah. And I mean, that's just becoming that much more and more popular. There's so many franchise groups out there that own 2,000 restaurants or 1,000 restaurants or 800 locations of whatever. And, with what Blackstone's doing and some of these other private equity groups, we know that that's what just continues to happen. So we're just building this brand, focusing on, again, our repeatable income, repeatable processes. And as we grow the brand even that much bigger, we're going to then serve it on a silver platter to some sort of, larger equity group that wants to make this play. Taco Bell's recently trading at a 22 to 24x EBITDA. A 50-store Wingstop deal was just done for 18 to 20x EBITDA. And so even, we're penciling 7 to 8x EBITDA. But I just love seeing what's happening in this business model. I mean, in the repeatable world, the valuations are starting to get really good.
Sure, I can imagine. Talk to me about the data and how the locations are driven by data and things like that. Because I'm sure one of the things people worry about is a store not being successful. And I think I've worked in commercial brokerage and work with QSRs and other retailers and all, and I'm always just amazed by how much data is accessible to them and how much they know before they get in and have a pretty good feeling on, how much money that store is going to make because of all the data they're able to get about traffic and the location and the demographics and all that kind of stuff. So I'm curious to speak a little bit more about the data side that drives the decision making and how you feel confident that these stores are going to continue to stay open and thrive. You know what I mean? Because I think there was a crumble cookie across the street from me. It seemed like it was doing well. I mean, when it first opened, it was kicking ass, and every teenager in the area here was buying cookies. And then it went out of business. It was literally, I think it was open for a year or two. So I was shocked. So I'm curious to, how you feel confident when you open a store, it's going to stay open, all that kind of stuff.
Yeah, I love talking the nitty gritty. So I love getting into the weeds because that's where we make money. It's fun to talk about the big vision and this and celebrities and whatever.
Yeah.
But I like to ask the questions you're asking, right? And one of the most important is, how do you pick real estate? Because if you do not pick a good location, you're doomed before you even start. Or if you pick a location that's too much rent to compare to your sales and things along the lines of that. So a lot of times when I see businesses go out, we get a lot of phone calls now when businesses are going out of business. And a lot of times the landlord will tell us, oh, they were paying X amount in rent. Well, I can tell you they're going out of business before they even opened, because your rent to sales ratio is a really important. So understanding, like you said, what your sales will be, and then in proportion, what your rent to that. If all of a sudden you're doing 100 grand in sales a month, that's great. But if you're paying 18 grand in rent and paying 18% of your sales, you're out of business, you know? And so it's really important to make sure all of those line items are aligned. Now, how do we do that? So again, using technology, going from where are we looking, where are we hunting, down to the square mile, where's our demographics, then using local brokerages to understand all those intricacies, you know, where do people go to work, what side of the road are they driving on? And then when you find the final location, putting that back into technology, and that's where you were talking about, which is where you can actually get an idea of what your sales will be before you even open the store.
Yeah.
And we have that ability through cell phone data, through tracking. We can tell when people are going to that shopping center, when they're coming home from it, how long they're staying there, work that backwards and compare that across 100 other locations. And you get this ever evolving model that just continues to get better and better. Um, then on top of that, you make sure you sign a good lease where you know your rent will be a good portion.
Yeah.
The way that we're structured, we have no debt, you know, so you know, to see a crumble cookie go out of business, or, you know, I mean, we see large smoothie places go out of business every. And I sit there and I'm like, I say the same thing you do. What are you doing? You've been given everything. But if all of a sudden they sign a bad lease and have too much debt and are not a good operator, they've never done this kind of business, there's 3 strikes and you're out right there.
Yeah.
And it doesn't matter what brand you are. You know, I was recently talking to a McDonald's guy who owns, I think he's opening or taking over a 7th or 8th McDonald's. You know, he was taking over McDonald's because the previous owner just didn't care anymore. They weren't going in. Their sales were down 30%. And that's McDonald's, you know?
Yeah.
So customers really do need great experiences, and they need them every single day. And they need, you know, you like to have a great business takes a lot of things working in the right direction.
Sure.
And you know, it's really important to make sure. And that's one of the reasons we structured this the way that we did, with having no debt, with doing the equity instead of a pref split or any kind of waterfall or whatever, is all of this is aligned so that when the stores win, the investors win, you know, Sloan Capital wins, Everable wins. We are all aligned to win at the exact same time. And I just think that's the way it needs to be.
Yeah. I think that alignment is such an important thing, and yeah, it's funny because I would bet the crumble that, you know, that was a brand new development. So and I'm sure, you know, the leasing on a brand new development is typically well above what market rent is. So I'm sure the lease they signed was probably astronomical, and it just wasn't practical at the
And
end.
then sometimes build out costs are that much more too, because yes, they got a TI package, but if they don't have an HVAC or they don't have plumbing or they don't have a bathroom, you know, sometimes 50 or 100 grand a TI seems like you're getting a great deal until you walk in and have to spend that 50 or 100 on an HVAC system you thought was already going to be there,
Yeah.
you know? But new landlords or new tenants and stuff like that do not know all of these intricacies.
Sure. Oh my God. Yeah. Yeah.
You know, and honestly, a lot of brokers are not sitting there telling their tenant to go get an HVAC report to see what the age of the H, because they don't want to blow up the deal. They want to make their commission.
Exactly. Yeah.
And so it's really important to make sure you have someone that fights for you, fights to get you a good lease, make sure it's structured. We had someone try and put a 4% annual increase into one recently.
Yeah.
And I'm like, you take that over 10 years, 4% on 4% on 4%. No, we got to renegotiate it to 2%. That's a difference of thousands of dollars a month over the course of the next 10 years, you know?
Yeah. Oh my God. Yeah. We represented a landlord that wanted a CPI. And so whatever CPI was, I mean, they want that increase. And it was a KFC deal. You know what I mean? I always think it's funny that landlords and owners think that the larger the corporate companies, and I mean, the franchisees and things like that, they can just kind of afford anything, you know, and they want to be in this location. And I always think it's funny because they didn't get to where they are just affording anything, you know, and they got to where they are making very strategic, data-driven decisions. And that's when you look at like places around here, you know, like a Chick-fil-A or something, where it's just like I don't know if have they ever closed the store, you know what I mean? Like, or maybe in the early days, but it's just you don't see Chick-fil-A's close. Wawa's another one, you know what I mean, where it's just like they have that down. They've closed some stores in the city for various reasons and things like that, but for the most part, you know, they know what they want and they know how much the stores are gonna make and all that kind of stuff. And I would assume, you know, the larger you get, the easier it is to get for that kind of data, and the more you can afford when it comes to acquiring that data and making those decisions and stuff like that, right?
Yeah, I mean, everything with us keeps getting better. With size means we can negotiate better against certain vendors.
Mm,
Landlords give us better terms. It's
mhm,
very often we're getting, 6 months to build out a place plus 6 months of free rent when we open.
yeah.
So then, when landlords want us, you can go negotiate those things. Then you can use that money to market, to grow your business more, to be, it just size really helps.
Mhm.
There's no question when got into Dallas and we had zero, and other people had four or five or six. Now we have eight, and those same ones with four or five or six are down to zero or two, maybe.
Mhm.
Um, size really helps for sure.
Yeah, interesting. And then how are the leases structured? So are they typically as a gross lease, as a triple net? Are you responsible for everything, or like what does that look like? And
Yeah, just
then
standard triple net leases. And now what's inside of those triple nets definitely varies landlord to landlord. Some landlords want us to be responsible for everything out to the street sign, and
yeah,
others are more about what's inside of our four walls. So, it's really important to look at all those leases, compare them line by line, and make sure the whole package makes sense.
yeah,
Like I said, even down to what is the HVAC like? Get a report, make sure, because all of a sudden you're, taking over a 40-year HVAC and you're responsible for those repairs and that efficiency and stuff. Things like that can really hurt your business as well. So
hmm
we really look at every detail to
mm,
make sure that it's set up for success and can help us give a repeatable model to our investors.
hmm
That's our investor. I always think about, like, what problem are we solving? And with our investors, they have dollars that they need to get return on and
yeah,
want depreciation and want cash flow and all those kind of things. So down to how we analyze HVAC at each store is
yeah.
part of that model.
Yeah. Oh my God. I could imagine. Yeah. And understanding the lease and how it works and what you're responsible for, all that kind of stuff is going to make a huge difference down the line. You mentioned depreciation there. How are the investors participating in depreciation? Can you depreciate everything that's
Yep.
in the store and all that kind of stuff? Or nice.
Equity, baby.
Yeah.
It's one of the reasons I do equity. So if you own 1% of all the restaurants, you get 1% of all the depreciation. You get 1% of all cash flow. You'll get 1% of the exit. That's it.
Mm.
This
Yeah.
is, again, this is meant to make sure the investors win right alongside of us. There's
Yeah.
never any confusion. I send out P&Ls every quarter. I'm an investor in about 19 or 20 different companies.
Mhm.
And I'll tell you what, like, people don't communicate all that well. You
Sure.
know,
Yeah.
I mean,
Mhm.
it's K1 time right now. I can
Yeah.
tell you, I don't have a lot of them ahead of schedule.
Yeah.
But I just think that that's called being a responsible advocate for, and responsible for the people that are trusting you with money. And in the case of, how we communicate, sending out quarterly letters. But again, every time we sign a new lease, I'm notifying our investors. Every time we have a grand opening, every time we have a new partnership, we're going to be on a really big TV show
Mm.
featuring one of their products in a few weeks. Like, I
Yeah.
want my investors sitting by the TV on Friday night cheering
Mm.
if they know they're part of that brand.
Yeah. Yeah.
And it makes it a lot more fun.
Oh, I could imagine. Yeah, that's great. How do you make those decisions from a marketing perspective? Yeah, because I know from what I do, I mean, you could just spend all the money in the world, on marketing. Some things are going to move the needles. A lot of them aren't. You know what I mean? So, how do you make those decisions? And do you get guidance from corporate and all? And what does that look like? You have commercials. How do you get involved with the local? Radio or local schools and churches and things like that. You know what I mean? I'm curious to understand that because I would think the marketing and people knowing that you're there, obviously, like you said, you're in places that there's other anchors in the places that you're at. So you're getting that visibility right there. But I'm curious to how you show up, you send flyers and stuff, or I mean, how does that work and how you make those decisions?
Yeah, so I like to give the analogy of Jimmy John's. So when I used to work in my cell phone stores, every few weeks someone from Jimmy John's would stop off and give a little sample sandwich. Remember those? They'd hand wrap the little tiny sandwiches, and maybe
Yeah,
you get it.
yeah. I had a friend that worked at Jimmy John's in college.
Oh yeah, and I mean, like, it was the best thing in the world when they'd come by our cell phone store. Us and all the employees, we'd always get excited. Jimmy John's, bring a little snack for us. But what happened was, at one point I went, "Oh man, I'm hungry. I'm gonna order Jimmy John's."
Mm.
You know?
Yeah.
And that is really marketing right there. And so there's a lot of different ways to do it, but nobody used to know who Jimmy John's is, and now everybody and their brother knows who it is,
Sure.
right? And
Yep.
so that's what you do is you literally start by just giving out samples. So we host a huge grand opening for a few hours, have literally a line around the building, and everybody gets a free bowl.
Mm.
I mean, the average one gives out 400 or 500 bowls. That's a bowl every like 40 seconds. We will literally shut down traffic and we will promote the heck out of it because we're a new concept people haven't tried before. So we want to get that food into their hands and trying it as fast as they can. Now, when they're in line, I want them to have a sample of a smoothie or of one of our avocado toasts or different products, or flavored lemonades, whatever that might be. And on top of that, I want them to download our app because when you download our app, your next bowl is free too.
Well,
So now all of a sudden, you've now tried multiple product categories and multiple bowls. You have an app on your phone. Guess what? You're basically a lifelong customer. You might not know it yet. Now, over the course of the next 3, 6, 9, 12 months, whatever it is, we're going to continue to pour on that. As you're at work, you're going to be surprised because people will drop off little samples in there. When you're at a 5K tournament, your 5K run or a marathon or your kids' volleyball tournament, you're going to see Everbowl over in the corner there serving food, giving out samples, and just being as many places as we can. And then again, one day you wake up and you're a household brand. And so, we're always looking at those partnerships. We're always looking at, whatever we can do to just keep on finding more reasons to have people try our food for the first time. And with that, then they become regulars.
Is there a percentage of revenue or that you want to put towards marketing generally, and does that change when a store just opens versus a store that's been open for a few months or a few years, something like that?
Yeah, I would say it's more a dollar amount than a percentage, and that percentage changes as you grow. Like
Sure.
you need to be spending, at least $1,000 to $2,000 kind of at a minimum to just be seen or heard or felt. It's really hard to spend $300 a month on an Instagram ad or two and then be surprised that your door's not swinging, right?
Yeah.
Whereas if every month you can say, I'm going to put $300 behind Instagram, $500 on product drop off, $500 on local micro influencers, this ad over here. I'm going to sponsor this volleyball team. We're going to do a get like now I've got 8 different things that I'm doing that month. And together those things make an impact. You never quite know. There is no silver bullet. Like there's no one place that you can spend money and it will just work.
Yeah.
It really is doing everything every day. And you want the best marketing tip in the entire world is make sure whoever is behind that counter, that's your fine. It doesn't matter how much money you spend on marketing if that person behind the counter doesn't give that incredible one of a kind experience.
Yeah. Well, what a transition, because that's exactly what I was going to ask you next was, who trains the employees? That's 100%. I feel like the people working there and how many shits they give, to put it in the nicest way I can, is such an important aspect. And there's a Qdoba close to me. It's been there for 100 years. And I've gone on and off over the years, and it's over the years, there's been people that work there that just nail it. They seem to love working there for whatever reason. I mean, they really enjoy what they do. And it's like there's cycles. You know what I mean? Like then there were times where I didn't go for probably years, you know what I mean? Because I had a bad experience. I'm the kind of guy where I have a bad experience. It's hard to get me to go back. And so a couple months ago or whatever, I was desperate, and it was the only place like open, because they're kind of open later than most. And I went, and we were back to a crew that just gave a lot of shits. And they were they cared. I mean, they were happy, they were nice, and I think I've been back there 2 or 3 times since then. You know what I mean? And it was the same people, thank God. And it was a great experience. So I love what you're saying there. Let's talk about that, because I think that's so crucial. Are you guys training, and what does that look like? How do you make sure people care and that they're getting and delivering a really good experience?
Yeah, so Everbowl at a corporate level creates a training program, and then it is our job to execute that training program and graduate people and make sure that they're capable of giving that experience. But as you know, giving that experience can vary depending on what kind of business. You mentioned Qdoba. I like to talk about Chipotle because I can't tell you how many times you go into Chipotle and they can't even give eye contact to you.
I won't go. Everybody that knows me knows I hate Chipotle with a passion. I mean, and I used to love it. I mean, back in the day,
Everybody used to love it.
right? It was amazing. And I would travel far. I mean, there was a few around here. They weren't that close. I would travel and it was a great experience. I mean, nowadays I hate them with a absolute passion.
Right.
That's why I was doing it with Uber.
Exactly. I mean, and I told the story earlier about the McDonald's owners that took over and their store was down 30%. So the issue that you're talking about is everywhere. If customers go in somewhere, it doesn't matter how great your brand is. It doesn't matter if you have golden arches, people will go to a different business.
Yeah.
And so that all comes down to culture, and who you hire. At a store level, it starts with who is the store leader. And in my business, we sell a lot of strawberries. So I love to use the moldy strawberry analogy. But if you ever get a tub of strawberries and you put them in your refrigerator and you open up and there's one of them that's moldy, if you pluck that moldy strawberry, every other strawberry stays bright and beautiful and juicy and ready to eat.
Yep.
If you leave that moldy strawberry in there, it's game over. Next time, the next time you open up that, 2 or 3 are going to have mold. The next time you open up, 5 or 6. And that is really the game of retail and restaurants and everything, is hire amazing people. Make sure you have an amazing leader that fits your core values, that shows up every day and wants to be there. And then what happens is they, duplicate to everyone around them. Whereas when you have a leader that is angry or bitter or going through whatever and they show up and they don't want to be at work and they're frustrated by whatever, well, how is their team supposed to be excited? If they don't treat the guests great, why would their team treat the guests great? And all of that duplicates down. So it's all a matter of find the best strawberries you can and then pluck the ones as fast as you can that are potentially damaging your other ones. Because listen, I've got 10 stores open. I can tell you, we can see it when little things happen, when a new competitor opens, when we get a leader that might not be the right one, when this, and then we can go down to the hour of each person who works and tracks what's their tip, what's their this, what's the, you can get really granular with it, but your guests are doing that for you. So you might as well do it for your own business.
Yeah. I love the strawberry analogy. That it paints a very clear picture of what can happen. If you leave it in there, that kind of thing. How do you compete on like the pay? Because I know some people that work in retail, and they've told me that it's really hard to bring good people in when you have another store, in the shopping center, or the one down the street or something. They're paying, $10, $12 an hour, and that other one down the street's paying 18 or something like that. I mean, so how do you guys, how do you stay competitive in that sense while also, operating the business, being profitable and all that kind of stuff?
Yeah. So, I mean, every market's a little bit different. If you go to downtown Dallas, that will have a different type of employee pool than you would out into a suburb or into this or one that's fueled by a high school or something like that. So everything is market to market. But I'll tell you, the best thing you can do is be a cool place to work. It's all that culture thing. I mean, we open stores sometimes and I don't even have to place ads. We literally opened one of our most recent locations and we had the entire thing staffed based upon a window decal we had put up during construction.
Wow.
Because people are Googling Everbowl and looking at Everbowl. And, there's a lot of high school and college kids that are looking for their first job. They want somewhere that's healthy. And we just build a great culture about making friends and having fun. Those are 2 of our 5 core values. So, we want our team members to walk into our stores, to be high-fiving the customers, complimenting the customers, smiling, creating relationships. And when you create that, then naturally they want their friends to come work there. They want their sister, their brother, and all of a sudden, we'll even see it where kids will go off to college. They'll bring in their replacements and say, hire this person to take over the,
Yeah.
And when you create that kind of culture, the pay works itself out. We don't have to pay premium over, but we also give them a great, better work environment.
Sure.
Like I said, they're off by instinct every night. They're not having to deal with fryers and, and pizza places that are open till 2 in the morning or whatever it is.
Yeah.
We instead are just creating a healthier, better conveyor belt style of fresh fruits and ingredients. And with that, giving a great guest experience. And we're very, very fortunate that just overflow with great applicants.
Who makes that decision on the on like the what the pay is and that kind of thing? Is that driven by the franchise or
No, that's down to the store level. You can pay
store
whatever,
level? Okay.
we have recommendations of which
Okay.
roles
Mhm.
to hire and what those roles do. But as far as how you want to pay, who you want to pay,
Yeah.
some owners
Franchise in the house.
one way. Yeah.
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 That's
I mean, at the end of the day, and then, but you get every franchise, I don't want to say every franchise, every good franchise will give you what's called a franchise business consultant or franchise business coach. And
okay.
so we work right alongside of our franchisees to help them understand their labor models, understand their structures, make sure, they've got guidelines and KPIs that they're trying to hit to help make them more successful. So it really is this, universe where we want to help them be successful and understand all those metrics of the business. And someone that only has one or two locations will look at it differently than someone has 10.
Mhm.
And, that's how it should be. But we
Yeah.
we even have a franchisee community where every 2 weeks, literally dozens of owners from all over the country log in, sharing best practices, better ways to hire people, better ways to market, better, all that kind of stuff, because the more we all win, the more we all win.
Yeah.
So it becomes this kind of self-fulfilling thing.
So to get back to the business side of it and all, and the exit and just that kind of that part of the conversation, how long does it take for a store to be profitable? Like if I'm an investor in this, I'm guessing the true payday is the exit, right? Is selling to private equity, or I guess it could depend, right? So how long does it take for profitability and then I'm curious, from a size perspective, do you become a little juicier for, a bigger private equity, and can you get a better price or something like that when the larger the portfolio is compared to if you only have 10 stores or 20 stores or something like that?
Yeah. So, interesting enough. So when I was going through being vetted by franchisors, they went through every store we've ran, every deal we've done, every dollar we've raised. They do a lot of due diligence.
Mhm.
And one of the things that they asked was that exact same question, was how long does it take for the average store to be profitable? And guess what? With our data, we know that. And the answer was under 6 months, 5.8 months to be precise.
Yeah.
So we are doing investor payouts very fast.
Yeah.
And that's one of the reasons that they love this deal as much as they did. Now, regarding exit multiple, like if we grow these stores to, let's say, even 700,000 worth of sales, 15 to 20% margin, pretty reasonable considering our rent and, everything that we have structured inside of there. We have no debt. If you get the business even making 120 grand a year per store, which is very, very doable, then you start looking, like I said, at that 6, 7, 8x, return at the size that we're currently at.
Nice.
But as like you said, if I have 3 restaurants, I might be a 3 to 4x EBITDA. At 7 to 8x, or 7 to 8 restaurants, maybe you're a 5 or 6 EBITDA. But one of the reasons that we are doing a big batch for this final batch is, first of all, there's investor demand. And it makes sense, rather than do one batch now and another batch later, to just do it all right now, fill it up, and get to work. But the other side of that is when we go to sell this thing, bundling all of that together and potentially even our rights to the state of Texas now makes a really interesting takeover target.
Gotcha.
And we've already had interested people, but we want to make sure we go execute at a higher level, because if we can do that, not only are you getting double-digit cash on cash to your investors pretty darn quickly, you're also getting them a double or more on the exit. And like you said, if you can, the exit's when most people are waiting for, but if you can pay them along the way for the exit,
Sure.
that's where everybody wants to be part of.
Yeah, definitely. So, and that was going to be my another question is like, how much are you kind of monitoring the private equity space? Because they can be a little fidgety, right? I mean, things change in the market. All of a sudden, they're really hot on something for a little bit, and then maybe they're not. So I'm curious to like how much you watch that private equity space, and then too, just structuring, the way that you operate the stores and all that kind of stuff to make sure it's easy for them to take it over? Because I'm assuming there's things that you could do that could make it less attractive for them or affect that, multiple, because they're gonna have to come in and revamp this or that, or, or they don't like, how a certain thing looks or something, and they need to, from an operational standpoint or something like that, they feel like they need to change it. So curious to like when that conversation starts and how that evolves and all that kind of stuff.
Yeah, so fortunately, I have mentors that have already done what I'm doing before. So that's why we actually structured the deal that we did. We actually have a shared management team across all of our locations in order to make sure if we're ever purchased or ever acquired, that people, if you need to install certain people or an accounting team or this or whatever, you can kind of mix and match how you do that without affecting the actual day-to-day of the stores, all that kind of stuff. As far as, the overall what's going on in the private equity and that, it's until you hear of deals that are actually happening and actually going through, everything's a bit of a rumor mill.
Sure.
And right now in higher interest rate environments, I'm actually surprised as much stuff is getting done right now as it is. So I don't at all, my opinion on exiting businesses is don't put fake time frames in your mind.
Yeah.
How many people bought multifamilies at 4.5 caps 3 years ago and told their investors they were going to exit it for a 4.5 cap in 3 or 4 years?
Yeah.
They made up fake time frames. They made up fake environments. And now they're sitting here going, oh shit, my interest rate's doubling. Now I could be lucky if I could sell it at a 6 cap,
Yeah.
and their investors are panicking left and right.
Yeah.
Whereas if all you do is focus on building a great business or a great property, and then the time frame works itself out. So I'm just a really big believer that right now we are raising funds to go execute a game plan, and I'm going to go focus all of my effort not on what's going on and who Blackstone is buying, but focus on making my stores win as much as they possibly can for our investors every single day. And when I do that, it's really weird because you become businesses people want to buy, and that part works. But if all you do is focus on the exit rather than building a great business, guess what? Even when that perfect exit environment comes around, you're not ready for it. And so we're making sure we're positioning, we're focusing on our profitability, we're making sure all of those KPIs keep getting better, where we spend dollars, how we execute our vision, how we pick real estate, everything just getting better, 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 better. And then naturally, when we go to sell it, they're going to see all of those things and done it before, we'll do it again.
Yeah, that's awesome. Well, and you mentioned that, yeah, it seems like you have some options with how the exit is. Like you mentioned, maybe selling. You have the ability to sell the Texas territory, that kind of thing. I'm assuming too, like you have these other franchises, in these other sub markets and things like that within within Texas that you're working with and all. So it seems like you have some flexibility on what can be sold. It's like the entire package can be sold, and then other things can be held, and you can continue to profit off of and all.
Yeah, I mean, if somebody comes along, I'm going to do whatever's best for our investors, right? So if tomorrow someone comes in like, I want to buy all of Dallas, guess what? If it's the right move for my investors, done. I am, I don't have an ego. I don't really care. The reality is if that deal is what makes sense and we can execute a vision and complete that faster for our investors than we thought, then that's done, but those are all what ifs.
Yeah.
And so, yes, I make sure that I give myself 100 options at all times, but our North Star is still very clear, which is take over Texas, become the acai brand of all over Texas. Our investors fund it with that. We get our advertising spend, keep growing, 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 grow that brand recognition, start doing the big sponsorships, getting to the big areas, and then with that, get the exit.
Yeah. Awesome. Well, wow, this has been a great conversation, very insightful, very educational, and just exciting. This is something that's, I have a little bit of experience with it on the commercial, brokerage side, but, the franchisee side and how you're making money, from owning the franchise and all, and what goes into it. It's been a great conversation with you, Justin. If people want to learn more about what you do, I want to get involved somehow. How can they reach out to you? How can they get in touch?
Yeah, so I love connecting with people. So I'm pretty active on LinkedIn, Justin Sloan on there, or our website, sloan-capital.com. And you can reach out on the contact me section or shoot me a DM, whatever works for you. But I love to connect with people that listen to the same kind of things and talk the same kind of talk that I do. So please, if you've made it to this far in the podcast, reach out. Let's connect.
Awesome. Well, Justin, thank you so much for being here. I really appreciate you joining me and talking to me for as long as we did. And I can't thank you enough.
Yeah, thanks so much. Appreciate it.